Well, I thought Mr. David Ige was going to say something. I don't know if he still wants to or not. Good morning, everybody.
I will, David.
Oh, okay, go ahead.
I'm just waiting to see, do we have, how many people do we have on? We hope that we have everybody's been able to get on. It's 10 o'clock in the morning here in Hawaii. We want to let you know that that David Luna is actually in Florida, and it's 3 o'clock his time. So we appreciate him making time for us. Before we get started, I just wanted to reach out on a couple things while people are logging in. One of them is we want to thank our platinum sponsors throughout the year for their support of Hamby, all right? And that would be Bank of Hawaii, Finance Factors, Angel Oak, Freedom Mortgage, Champion, Mutual Underwriters, VIP Mortgage, and Accra Lending. We appreciate them. And it's their support that helps us do what we need to do as loan officers and originators. So we really appreciate that. Now, with that, we want to spend as much time we can with Mr. David Luna. David sent me over his little bio, and I could read that. He's been in the industry since 1980, but I think David and I go back maybe 15 or 20 years. And David's done everything you could think about in the mortgage industry. I mean, he's been a commissioner. He's the one that scolds loan officers if they do something wrong. He points things out. He's also originated loans. He knows all the government regs from A. Is it a Reg A? Reg A all the way to Z. And those of you who attended his CE classes know that. He makes learning about our requirements and regulations very enjoyable and applicable in our business. So I'm grateful for that. He's worked with banks, credit unions up and down the West and East Coast. He's been on several different commission panels. And so we're grateful that we've got him for his experience that he can lend to us as loan originators. So without any further ado, I am going to turn the time over to Mr. David Luna, a dear friend and a great guy. All yours, Dave.
Thank you, David Ige. Appreciate it, everybody. We're gonna have time at the end for questions and answers. What I'm going to do is I'm going to go through the presentation, which you will get a copy of. So the presentation is being recorded, and the PDF of all the slides you're going to see, you will also receive. And so let's hold off as we go along. Ask whatever questions you want, but we're gonna hold off answering the questions until the end of the presentation, if that would be okay, please. And we've entitled this "Smashing the Crystal Ball." The crystal ball is kind of, well, what's going to happen in the future? So if you take a second and look on the right-hand side of your screen, what are the Feds going to do? What are interest rates going to do? Appreciation, inventory, the economy, how will it all affect us? First quick question, if you think those are topics that would be of interest, those are exactly what we're going to cover today. So what are some of the questions? Well, what is this terminal rate thing? What's going on with inflation, the economy? Are we going into a recession? Is it going to be short? Is it going to be long? What's going on with housing inventory? Do we really have appreciation, or is it all going to fall apart, and are we in a housing bubble? And I'm not trying to make fun or light of any of these questions, because some of them are very, very serious and they're very, very important. And when you have entities like the Federal Reserve talk about a housing bubble, you have some very serious questions going on in the industry. And so I want to talk about all of them. So I will use various sources: the National Association of Realtors, the National Association of Home Builders, Fannie, Freddie, words directly from Chairman Powell. I mean, we're going to look at all of these different sources, but I will, as always, convert things into English so that we can better understand them. We'll start with CNBC. By the way, the last time I updated this presentation was today, and so these are facts and figures as of today. So the Federal Reserve, according to CNBC, will hike interest rates to as high as 5.1 in 2023, before the central bank ends its fight against runaway inflation. This is what is called the terminal rate. Now, the terminal rate of 5.1 is equivalent to a target range of 5 to 5.25. So now let's put that into, what do we have today? Today, the Fed funds rate sits at 4.5. So if CNBC is correct, and I kind of think they are, there is room for more rate increases. Not something we wanted to hear about, but something that we will expect happening in less than 30 days. And I'll tell you what I mean by that. So Chairman Powell on the 10th, again, this was just today, he's in Sweden, restoring price stability when inflation is high can require measures that are not popular in the short term as we raise interest rates to slow the economy. Now, he's in a conference with other central banks around the world, and they're all trying to struggle with what they are going to do as well. But I think the bigger question is how much higher will the Federal Reserve go in 2023? And I'll help answer that as we go along. So the FOMC, the Federal Open Market Committee, will meet, as I mentioned, in less than 30 days. So at the latter part of this month, January, and then we will know what they're going to do on February 1st when the Feds make their announcement. This, by the way, gives you the calendar for 2023 of when the Feds will meet and when they will discuss things. So I want to give you a little bit more detail on that. When we talk about the Fed funds rate, it is my opinion that they're going to raise rates another quarter to 50 basis points here at the end of the month, and then probably another quarter to 50 basis points in March, depending on what the other indicators are showing. And we'll talk about the indicators in just a second. Who makes these decisions? If you look at your screen right at the bottom, you have 8 permanent votes. So you have the 7 Fed governors, and then you have the president of the New York bank, right? The New York Federal Reserve, who is a permanent member, and he's in the 2nd district. The country is divided up into districts. So for 2023, if you look at the different colors around the country, you'll see that Minneapolis in the 9th district, you'll see Dallas area in orange in the 11th district, you'll see the Chicago in the 7th district. It rotates. So these are those additional votes that will go in with the 7. So 7 plus New York makes 8 plus 4 more gives us the 12 votes to determine what's going to happen. So does it rotate, and do we see Hawaii on there? Well, no, Hawaii had their opportunity. Again, to be fair, it rotates around the country. So now let's look at some indicators. So PPI, the producer price index, came in at 0.2. Well, what does that mean? It means that it's slowing, okay? It's 6.2 from 6.8 last month. And with it slowing, that is very, very good for inflation. And again, kind of suggesting that the Feds have really hit what they wanted to hit, though we will see additional raises in the Fed funds rate. The Institute for Supply Management has 2 indexes, the Manufacturing and Services Index, and it shows a contracting economy as well. So with both those surveys showing slowing inflation as well as improving supplier deliveries, it looks like the effects of COVID might be wearing off a little bit. We still have some supply chain issues, but it does look like we are moving in the right direction. CPI, the Consumer Price Index, again shows signs that we're slowing. The next CPI report comes out in just a few days, January 12th, so it's this week. Inflationary data is trending lower. Job growth and economic growth rate are also slowing. But Dave, I just saw the December jobs at 220 plus, thousand jobs. Well, let's take all of the information together, not just piecemeal. Let's take it all together and figure out what the information is conveying to us. So we are not trending like we were in 2022. We believe that we will see fewer and lower rate hikes in 2023. But let's get other people's opinions on what's going on. So Mr. Doug Duncan, a friend of mine, who's the senior vice president and just an all-around very, very smart economist for Fannie Mae, said in December, consumers, okay, so this is not industry, this is consumers are reporting increased expectations that mortgage rates and home prices may decrease. So the consumer out there is sitting there saying, I think it might actually be getting better for me to try and buy a home. Now, what am I thinking is really going to happen here at the end of the month? I'm expecting, as I mentioned before, a 25 to 50 bip interest rate increase on that February 1 announcement, and then probably the same in March. Then after that, it looks like, because everything's starting to slow down, has the Federal Reserve hit their goal, and will they keep these numbers lower or will they keep higher? We'll talk about all of that. Rentals, okay, if they can't afford a home, they can't find a home, you know, consumer sentiment is starting to feel better about getting a home. Where are they going to live? Well, they're not living with mom and dad, so that's gone. They are now older, and we'll talk about the ripe old age of 33 to 34 in just a second. You have rental supply that's coming on board here, about 1 million units very, very soon. Gone are the days where, you know, people would stay in their home for only 5 to 7 years. There isn't anybody with a 3% interest rate that's thinking of moving out of their home. Okay, they're sitting there saying, I'm going to move, I'm going to walk away from my 3% interest rate for a 6.5, you know, rate to maybe try and find something that isn't really available. Yeah, they're staying. And so the numbers are skewing that people are staying in their homes longer, maybe for 11 years. That might be the new norm. What we need is new single family residence inventory. There's a great deal of wealth that has been created. And so these numbers that you're hearing, oh, home prices are dropping, it's trying to sell news. It's trying to get eyeballs. What it's trying to do is have you tune in. Well, let's talk about reality. So what's going on is property increased in value, and let's go all the way back 6 months. Properties were just skyrocketing in value, right? And so the neighbor next door that sold their home had multiple offers, and they sold for X over asking. And the neighbor saw that and said, wow, maybe I should sell. And so now they're sitting there thinking, well, I shouldn't sell yet because I've got to fix a couple of things. And so they take a little while and they fix those things. And now they put their home on the market thinking, I'm going to get multiple offers over asking. It's going to be great. I'm going to do it just like my neighbor. And that is not the reality. So when the news tells you that prices are dropping, it's sellers' expectations of what they thought they were going to get, which are now becoming a little bit more real. They're becoming a little bit more in line with what's going on in the marketplace. So you guys should see that as well. In other words, if you, wherever it is that you're practicing on the islands, right? If you are seeing the same thing, just go ahead and put it in the chat and say, Dave, seeing the same thing. Seller expectations are coming a little bit more down to earth. So now let's talk about the Federal Reserve Bank of Dallas. March, so about 9 months ago, they were talking about a housing bubble. Again, news is meant for, you know, viewers, for readership. Is there a housing bubble? Well, let's talk about that one for just a second. Are we in a housing bubble? So what happened in 2017 and 2018? I can only go back to past models to kind of predict what's going to happen in the future. Interest rates were rising. Sound familiar? Payments got more expensive. Sound familiar, right? There was no drop. There was no bubble. The median home price rose from $299,000 in early 2018 to $319,000 1 year later. There was no bubble burst. So then you have this other piece of information from the Federal Reserve Bank of New York, one of the permanent voting members, right? They did this survey of consumer expectations. What do consumers think? Well, wait a minute. A plumber, a baker, a heart surgeon, a lawyer, all wonderful professions, but they are not in our profession. So the key part of this survey of consumer, just just dwell on that one word, consumer. Consumers think we're going to have a housing crash like we did in 2018. And if I go backwards, back to what the Federal Reserve Bank of Dallas said, I mean, that might give them fuel for that kind of thought, even though Dallas and New York are different. Will there be a housing crash? In one word, no, no. And I'll back that up with further information as we go along from the National Association of Realtors and Dr. Lawrence Yun, who is the chief economist for NAR. Now, labor costs and wages. Revision showed that labor costs, which were about 70% of the price of goods and services, increased at a 2.4% annualized rate. Now, a number by itself is fine, but putting it into perspective, this is the lowest since the first quarter of 2029. So these wages, these labor costs are also slowing down. Should they continue to cool in 2023, that would also be an indicator to the Federal Reserve that you can stop raising rates. Now, I want you to just look at this arrow here for just a second. Just concentrate on the arrow. The yellow is mortgage applications. That line is the National Association of Home Builders. So we're looking at in the future what's going on. So this data is as of December 28th, 2022. It's only a few days old. Notice how the yellow line went above what the National Association of Home Builders index was. This is showing that there is more applications for homes if we look forward 2 to 3 months. So again, we're not out of it yet. We won't be out of it in first quarter or even, I apologize, second quarter of 2023. But the third and fourth quarter of 2023 and definitely 2024 looks really, really good. Now, this is Dr. Lawrence Yun. His what he's communicating to his members and everybody else, despite inflation, elevated mortgage rates, and severely limited housing inventory, it will prevent large home price drops for most of the country next year, talking about 2023, according to the National Association of Realtors. Now, I don't know who the gentleman is to the right, but here's some thoughts. If the Federal Reserve hikes short-term rates by 50 basis points in the next 2 FOMC meetings, what might that do to mortgage rates? Well, here's something that I want you to think about. Some believe that 100 basis point increase is already baked into the rates that we see today. I agree. I think rates have room to fall farther, and I would not be surprised that if by, say June, 5 months from now, you're seeing rates solidly in the 5s, possibly low 5s, maybe even high 4s, but I'm going to stay in the 5s, which I think will help. And it also does a couple of other things. So recently, the National Association of Realtors had their real estate forecast summit. Of it, I wanted to do one quote that Dr. Yun said to back up what I just told you. Quote, I think the mortgage rate could go down even further because there's a gap between 30-year fixed and 10 years. So generally on the 10 years, there's a little bit of room, a little bit of a buffer. The difference between wholesale and retail, there's this profit in there that's built in. Now notice what he said. This buffer, okay, and inevitably the abnormal high spread, which is in there built in, it's baked in right now, will begin to narrow, which means that there is even further room for mortgage rates to decline in the upcoming months as the spread narrows. Generally speaking, there's about 150 basis point spread between the 10-year and 30-year fixed interest rates. Right now it's cruising, depending on the lender you're working with, between 200, let's just say round numbers, 250 basis points instead of 150. That 100 basis points could be a full-blown drop. So I really don't think I'm gambling too much if I say that rates will be in the low 5s very, very soon. Now, if we look at all kinds of rates, conforming, jumbo, FHA, VA, a year ago, yes, they were in the threes. Right now, they're about 6.1, 6.25, somewhere in that range, depending on who you're working with. So let me tell you how we got to where we got. The recession, right before the Great Recession, you had builders that were building subdivisions. So here's a picture of a subdivision that the builder just threw their hands up and just walked away. Now, because they had huge losses from 2008 to 2010, they just said, I got burned once, I'm never going to do that again. And so they only want to build homes that they know they can sell. Number two, when rates go above 5%, they also stop or slow down their building. So the National Association of Home Builders puts out their housing market index. And I want you to look at the red. If it's higher than 50%, builders view conditions as good. If it's lower than 50%, they're not all that happy. Look at July. Look at July of 2022. That's the last time it was over 50, right? August, September, October, November, that confidence, that outlook, that optimism is not there. Those numbers have not been that low for over a decade. Now, I want you to go down. I want you to look at single family sales next 6 months. Now, this is from the builders. What do you think is going to happen? So these are people knocking on the door. These are people that are sitting there saying, well, I'm not interested today, but maybe when school is out in the summertime, I might be interested in moving. Look at the indicator. That was dropping down through November. Look at what happened in December. That single family sales next 6 months went up. That is an indicator to tell us what's going to happen in the future. Builders are starting to feel like, okay, maybe we've hit the top of inflation. We have more people knocking. They are no longer in school. They're making more money. Maybe I can start to sell houses, and maybe I should start building again. Now, Mr. Dave Stevens put out a quote here. It was about a month ago, but we were talking about this housing bubble or crash or something. No. Look about the middle of the screen. The forecasted volume, never mind what MBA said about 2023. He said its forecasted volume will still make it one of the best mortgage years in the last 20 years. In fact, while it won't match 2020 or 2021 purchase mortgage dollar volume, it should be better than any year from 2002 to 2020. Ladies and gentlemen, it's not first and second quarter, but by June, July, this summer of this year, I think rates will be much, much better. And we are starting to see the clouds dissipate, the sun come out, and it's going to be much, much better. He continues to show this graph that goes all the way back to 1960 and what has happened to property appreciation. Folks, property values just go up. Now notice the graph, it's not a straight line. It never moves like this. There's ups and downs, but generally speaking, it always moves up. From Freddie Mac, while mortgage market activity has significantly shrunk, and it's not, again, what we saw in the past, inflationary pressures are easing and should lead to lower mortgage rates in 2023. Thank you, Freddie Mac. Inverted yield curve. An inverted yield curve in English means when you deposit your money, generally if you tie your money up for a longer period of time, you're going to get a higher rate. Inverted means you're going to get a higher rate for a shorter period of time rather than longer. So if you look at the 2-year, if you look at the 3-year compared to a 10-year, it's inverted. And that's just weird, okay? It's an indicator that we are possibly going into a recession. Now, some people are saying, well, Dave, we're in a recession now. Well, I don't think so. I think parts of the economy may be in a recession, such as housing, but not the rest of the economy because, again, people are still getting jobs, okay? So let's talk about this millennial, this 26 to 41-year-old. 4.8 million over the next 3 years will turn the ripe old age of 33 or 34. Now, why do I keep teasing about, the ripe old age? that is the prime age that people go to buy a house. They're done with school. They're not living with mom and dad. They're sick and tired of renting. Their friends that, moved out and bought a home, they see the appreciation that their friends have gotten, and they're saying, I need to make this change. Folks, this is the largest group of individuals ever to move through the pipeline. They don't want a place to rent. They can't afford it, okay? They want a place of their own. But in the meanwhile, you're seeing lots and lots of apartments being built. These housing inventory issues will not be resolved for years, and we're about 5 million units too short. Now, the chief economist for Moody's is also saying that this age group, okay, is moving into the home buying mentality. This is the biggest population wave to hit in their home buying years that the nation has ever seen. Now, what do these young people know? In one word, look at your screen, education. They believe that they have to have 20% down. In the chat, how many of you guys would agree that young people, first-time home buyers, believe that they have to have 20% down? Just go ahead and make your comment, right? How many believe that? I don't know where that's coming from, but that's what they think. So if you have increased fuel and if you have increased food, right, they're sitting there thinking, well, I can't afford a home now. They don't know that they can get into a home VA 0, FHA 3.5, conventional 3% down. We as an industry need to educate them. So would you agree with that word that I popped up? Education is what these young people need as well, not just on a down payment, but what their credit score needs to be and what their DTI needs to be. The Urban Institute, talking about minorities. You're going to have minorities move into this home buying mentality very, very soon as well. Vacancy rates are down, rents are up. Looking at vacancy rates, and this is from the U.S. Census Bureau, there's less and less units. That's why builders are buying more and more, and more apartments are coming online. The average rent, $1,700–1,800 a month. Many areas, especially in say Hawaii, are well over that number. But looking at the data of more than 20,000 apartment buildings across the U.S., what we're seeing is that number may be changing and actually going down. Starting in October, adding in November, and then again in December, we're starting to see, okay, rents start to actually drop, not increase, but drop. When they throw out the CPI or the Consumer Price Index number, shelter is at a 4-month low, the cost of shelter, and is falling quickly. Higher rents is why CPI looks so high. These, looking at the pie graph, housing at 42% is the biggest chunk of CPI, the Consumer Price Index. And so that's why the Fed looks at it. What do people pay for shelter, for housing? And that's been playing a part on what they are determining, inflation is doing. Rents are coming down. In the top 30 metro areas, they are coming down. And so Chairman Powell says, as that lease expires, now you get to renew it. They're sitting there saying, those renters are saying, wait a minute, now I have other options. I have more housing inventory coming online. I have interest rates starting to go down, and I'm starting to get a feel that maybe I can afford a house. As they work through that backlog, inflation will come down sometime next year, referring to 2020. We have to talk about COVID. We have to. It was a major influence, not just in restaurant hospitality, but shipping and construction. Supply chains are loosening up. Prices should stabilize, back to Chairman Powell. With higher interest rates, slower growth, and softer labor market conditions, it will bring down inflation. They will also bring some pain to households and businesses. The jobs report, and I thought I'd go directly to the U.S. Bureau of Labor Statistics because the number has been all over the place. So I took a screenshot, okay, of what happened on January 6th, last Friday, 223,000 new jobs in December, which brought unemployment down to 3.5%, the lowest it's been in 50 years. That is not a good indicator with everybody working. It's good for us in the mortgage industry because people have to have a job to pay back their loan, but that's another reason why you're going to see an increase in the Fed funds rate at the end of the month. Now, why so many jobs? Well, look at the little kids and parents staying home with the little kids. Now that COVID is hopefully, we've got our arms around that situation. Okay, ADP's chief economist says now that schools have reopened and childcare providers are open, it's supporting parents' ability to return to work. And maybe that's one possible reason why we're seeing bigger job numbers. You're going to see those job numbers actually reverse and you will see unemployment increase before this is all over. From the MBA, the housing market leads the US into a recession and it's likely to pull it out of a recession, says the chief economist of the Mortgage Bankers Association. His quote, Mike says, with recovery arriving around the middle of next year. Now you're seeing, not just from me, not just from MBA, not just from the National Association of Realtors, not just from builders, everything is pointing to mid-year this year of things starting to, turn around. One of the variables that no one can control is the Russia-Ukraine situation. If one of you can tell me exactly how this is going to end and when it's going to end, I can give you a better prediction of what's going to happen in the future. Okay, so Chairman Powell, who's a lot smarter than I am, although gas prices have turned down in recent months, they still remain well above earlier year levels, in part reflecting Russia's war against the Ukraine, which has boosted prices for energy and food and has created additional upward pressure on inflation. Well, Dave, who is winning? Who's winning are the higher priced homes, right? Builders are building higher priced homes. Would you agree? Okay, just in the chat, just go ahead and put your remarks. Would you agree that there is one, not enough inventory? And number two, would you also agree that there is not enough affordable housing out in America today? Would you guys agree with that? So we asked the question to the National Association of Home Builders, and it's like, why can't you guys build an affordable entry-level home? And the response, I did not actually realize. They said, Dave, if you take into account all of the regulations, all of the costs for fees and stuff, it adds, in round numbers, $100,000 to the price of a home. You had 10,000 members of the National Association of Home Builders write a letter to President Biden saying, we're getting to a point, an inflection point, that threatens to derail the current housing and economic expansion if something isn't done. So Chairman Powell is feeling the pressure, but he is not responding to political pressure. He's sitting there saying, I think we're on track. We're getting our arms around this inflation scenario. It is moving in the direction that we wanted to, and we're going to stay the course. Lumber prices. Let me give you some specifics. It's come down from $1,733 for 1,000 linear board feet. Now, before COVID, lumber prices were around $400. Ladies and gentlemen, as of this morning, I checked this morning for you, lumber prices are below $400. So it's not lumber and the price of lumber to get to the job site. It is, however, reflected in other things such as windows. Now that does not look like diamond head in the window, to me. It's just shaped, different. Windows have gone up about 20%. It used to be 4 to 6 weeks. Now it's 12 to 14 weeks to get windows. And gypsum, the major component in drywall, that's gone up 21%. So the market is undersupplied by about 5 million single family homes because we just haven't made up what we need to since 2008. We need about 1.7 million homes built annually. We're nowhere near that. And so, folks, there is no housing bubble. There is no crash. Appreciation will continue to go up. If you have a home, your home will continue to go in value, though not as fast as it was in the past. So NAR surveyed more than 20 economic and housing experts, and the group predicted that home prices will appreciate by a more modest 5.7%. There is no bottom falling out, okay? It's just going to be a little bit more returning to normal. So we've given you this foundational support. We've given you a ton of data. And now as we start to wrap up, okay, get your questions ready as we start to wrap up. I'm trying to help you understand what's going to happen next. From the National Association of Home Builders, you had those people that were looking for a home and their inability to find an affordable home, so they stopped looking. They will start to come back. Home prices will slow their rise, their appreciation, and become a little bit more stable. However, in some markets, home prices will drop. Well, which markets are those, Dave? Well, let's have Realtor.com answer that question for you. So Realtor.com is looking at the top 10 places around the country where home prices are falling. Now, if you look at number 7, LA, if you look at, other places around the country that saw super high appreciation, you're going to see those markets coming down the fastest. From Redfin, an increasing share of sellers, again, they thought they were going to get this for their home, are reducing their prices after putting their homes on the market. So from Zillow, 2023, experts expect U.S. housing markets to shift in favor of buyers this year. We continue to anticipate ongoing increases, this is in the Fed funds rate, in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation from its highs to their target rate of 2%. They just have two objectives: keeping inflation at 2% and keeping the most amount of people working. Right now, inflation is out of whack. And so what they're going to do to bring down inflation, you're going to see more unemployment increase. That's what they're trying to do, is a soft landing. Now, this was updated December 27th. When we talk about housing inventory, it's not like what it was 6 months ago. 6 months ago, there wasn't enough inventory. As of right now, there's 8.6 months of housing inventory out there. Rates are coming down, inventory is going up, rents generally, the rental agreements have to be redone in spring. So now people are sitting there saying, well, wait a minute, let me go month to month for a few months. Let me go find something else. Landlords, they're going to work with these people, because if they don't, they will just go somewhere else. Remember, 1 million new units are coming on. Treasury Secretary Yellen, who used to also be at the Federal Reserve, said inflation may have peaked in the United States, but cautioned that prices may remain elevated for a little while longer. A friend of mine, Dr. Elliot Eisenberg, okay, as we're reading about manufacturing, right? Anything below 50 is contracting. It's right there on the edge at 50.2. If manufacturing enters recessionary territory, which is very likely as soon as next month, it would be manufacturing's 5th recession since, the housing bust of 2008, 2010. When the feds raise the Fed funds rate, it increases short-term rates like automobile loans, credit cards, home equity lines of credit, things like that. When the Fed raises the rates, it helps to lower inflation, and that helps us in long-term mortgages. So its actions in reducing the balance sheet, it strengthens the US dollar against other currencies, which is disinflationary and also helpful to long-term rates. So let me compare something in the past to something that's going on right now, okay? So what happened from 2004 to 2006, the Fed raised the Fed funds rate 17 times, from 1% to 5%. Now, the reason I picked this period of time is it's absolutely what's happening today, right now. We're at 4.5. This went all the way up to 5. My opinion is it will go up to 5 with the Fed increasing rates. What happened to mortgages? The average 30-year mortgage was at 6.29, and at the end of all of these, rate increases by the Fed funds rate, the long-term rate on mortgages actually went down. These things are good. Now, I've heard this quote that a recession is 2 quarters of negative GDP. Well, according to the experts, right, it needs to be a little bit more than just negative GDP. Production, employment, real income, other indicators besides GDP, right? It needs to be something more substantial. So I tried to put together what I thought would be indicators for a recession, and let's tick these things off one at a time. When the Fed raises rates, you have to agree that's what's going on. When the 2-year and 10-year invert, well, that happened. When the Conference Board Leading Economic Index, or LEI, now that typically falls months before a recession, ladies and gentlemen, it's falling. If construction slows, that's happening. And when unemployment hits 4% or less and we're at 3.5%, yep, we have a recession coming. In my opinion, it won't be as bad as other ones. In fact, it'll probably be a very, very short recession, probably 6 months or less. Now, from the Conference Board, look at the bottom where we've underlined it in red. This was back in November, so watch what they're saying. A recession is likely to start around year end, that was December, and last through mid-2023. Again, I'm trying to line up, kind of like dominoes, over and over and over. It isn't just me that's seeing it. I think that things will turn around by mid-year. So as we're almost wrapping up, I have 3 minutes to go. Let me kind of give you my final thoughts, and then we'll open it up to questions. I started in this industry back in 1980, so we're going to use that experience of more than 40 years as kind of a basis, because that's what I understand. When I got into this industry, Jimmy Carter was president, interest rates were at 18%, inflation, it was averaging 11%, so much, much worse than now. The Fed funds rate went from 11 to 20%. We're complaining that it's at about 4.5. That's not what's happened in the past. So what has happened to long-term rates? They went down to 12. So from 87 to 06, we had inflation a little bit more under control. Rates were what they were, right? The Fed funds rate decided to raise rates. Long-term interest rates came down again. I crossed out during the Great Recession because that was really an anomaly. Let's get to 2018, 2022, inflation 1.5 to 7.9. I mean, we all remember when those numbers got really, really high. Mortgage rates 2.5 to over 7, right? Fed funds rate basically from 0 to 1/4. We're estimating that it's going to go up to 5.1, 5.2. Now that I've shared all this, what do you think is going to happen to interest rates? And in the chat, if you guys are saying rates will come down, I am absolutely agreeing with you. So here's my final thoughts. And I think I did it right on time, Dave Ige. So hopefully we have time for some good questions. Ready? Mortgage rates will continue to come down. One, even if the Fed doesn't do anything, they've baked in enough that just on its own that rates will come down. But if we do get inflation under control, they would come down even more. I don't want to share what my real prediction is, but I think it'll be lower than 5.5. It'll be lower than 5. But I don't want to share what I'm really thinking. I want to be a little bit more conservative. Home prices will become more affordable as we get more inventory online and builders start to finish up the projects they've already started on. Housing inventory is rising. You have home buyers that have already put an earnest money, and to the tune of about 60 to 64,000 people per month are walking away from something that they've done earnest money deposit on to now have other options. They don't have to waive contingencies. They have more options to pick from. They can wait for the appraisal to come in to see if they're buying it at the right price. So all of these things are good. Spring looks good for purchases, but summer looks even better. With mortgage rates drop, if mortgage rates drop below 5%, you're going to see building really start to ramp up. We are not out of the woods yet, but the indicators look really, really good for mid 2020 and definitely for 2024 to see a really significant turnaround. If you want to reach out to me, just pull out your phone, take a picture of the QR codes or download it. And with that, David Ige, what I'd like to do is I'd like to turn over some time for questions in the remaining minutes that we have. I know we have a bunch of smart people, so I'm a little worried because you may ask questions that I'm not prepared for.
David, thank you very much for that major narrative and giving us an update and understanding about the crystal ball. Very good, very good. I don't have any questions. I kind of agree with you. I kind of thought that maybe rates would level off a little bit more earlier than maybe the beginning of the third quarter, but I still think that the second half of this year will be a very good year.
I agree. Absolutely agree. Absolutely agree.
But anybody have any questions, please type those in there.
Maybe Rebecca could also be monitoring the chat to see what questions we might have out there. Or we could unmute people, though that's kind of dangerous.
So far, no questions in the chat.
Oh my goodness, you guys are so nice. Thank you.
There's a lot. Oh, here's one from Gary Rosenberg. Do you think non-QM products will continue to grow?
Absolutely. Absolutely. Yeah, non-QM is, whether you like it or not like it, it's the future. It will continue to be the future. Nobody is really helping those self-employed borrowers. And okay, let me kind of clarify that. I don't want it to sound so stern, but most of us are self-employed, and we're going to take every available write-off we can. So our adjusted gross income on our taxes is going to be the lowest possible number. And you try to do a regular, normal Fannie Freddie loan on something like that, it shows that we don't make any money. But with non-QM and bank statements, it actually shows what are we depositing in our accounts. And so I would say non-QM actually makes more sense than it has in the past if it's done correctly. Now, let me give you an opposite example. Sprout. I think there are some lenders out there that may not be doing it the way that it should be done. And so will there be more mergers and acquisitions, more consolidations in the future? Yes. Will there be more companies that just fold up shop and change their narrative? Finance of America. I mean, this is not. I'm not throwing rocks at anybody. That is not my intention. I'm just sitting there saying, as we read in the news, things that are going on, we're getting this indicator that there might have been some companies that might have changed their strategy moving forward. That will continue. I think non-QM, non-QM is definitely the future, at least in the short term.
Yeah, thanks, David. We have another question. What is the best vehicle to educate the millennials on down payment, credit, and DTI?
Millennials are all about social media. So do not try and sell. The things that'll turn people off the fastest is if you try to sell them something. So be informational, be real, be relevant, be someone that these people can relate to. So if you support the local soccer or softball team or basketball team, whatever, and they say, oh, wow, this person's just like me. My kids are playing basketball like their kids are playing basketball. Oh my goodness, look, they're doing charity work or helping those that are disadvantaged. And look at this information that it's not 20% down. Social media, content, informational, educational, that is going to give you a lot more traction than trying to sell something to somebody. Nobody wants to be sold anything. They want to feel like they're making an educated decision. So if you can help them do that, that's going to give you the most traction. So, help them understand credit scores, help them understand DTI, help them understand programs, help them understand the options that are available to them, And that's how you're going to reach these new millennial buyers.
Any more questions?
Here's another one. It's not quite sure what they're asking, but it says, how does the cash out refinance tax going to happen? So maybe they're asking why or when that cash out refinance tax going to happen?
Okay, there is no tax. Okay, but I understand what they're saying. It's individuals that are doing cash out refis are going to pay a higher rate. So if you want to call the higher rate, points, fees, whatever, a tax, I guess that would work. It's just very, very interesting that Fannie and Freddie's still under conservatorship since September of 2008. They're just being a little bit more conservative on, just think back, second homes, just investment property, vacation, all that other kind of stuff. This is another layer of them trying to be, super, super conservative in what they're doing. And so the extra fees or tax, if you want to call it that, they're trying to discourage those people from pulling out cash. I don't agree with it. I absolutely don't agree with it. Who's going to touch a 3% 30-year fixed, right? Nobody. And so the only way they can pull money out to pay off high interest rate credit cards or, other debts that they may have, heck, pay for weddings, college, whatever, they're going to want to tap into this tremendous amount of equity that they have tied up in their homes. But then to penalize them, okay, because it's a penalty, it's a tax, it's an additional cost and stuff, I just don't think that's super, super smart. But, I'm sure that there are brighter minds than me out there working on something that I don't understand. But I'm going to agree with the person that made the comment. That just doesn't make sense to me.
And here's another question from George. Some people have talked about 50-year mortgage or higher amortizations like in Japan. Do you think a new norm of amortization will come in the future?
Absolutely not. So let's look at Japan. Japan doesn't just have a 40 or 50-year loan. They have a 100-year loan. And the question is, since Japan has had that 100-year loan, has it really increased home ownership? And the answer is no. Just look at the numbers. No, it hasn't. And so will a 50-year mortgage or even a 40-year mortgage get any traction? I know FHA is talking about those kinds of things as well. You're going to see interesting products come out. England's got the endowment mortgage. I think what we have here in America works, and I think it works really, really well. And I think 30s and 15s are a good vehicle. I don't really see it going much longer than a 30-year amortization because all the people are doing is just paying interest. It's just more and more and more interest, and they're in debt, for a longer period of time. So I like how George, used Japan as an example, because George, I'm agreeing with you on that Japan example, but we need to see, has it really significantly affected home ownership rates in Japan? And the answer is no, it hasn't. So brilliant question, George. What worries me is when I get super smart people that ask these kinds of questions and I go, okay, where are we going to go from here? So thank you.
If anyone has any other questions, go ahead and type it in the chat. We got a couple minutes left.
So Mr. Ige, while they're typing, we can talk faster than people can type. Have we set up our conference for later this year? Do we have any, golf tournaments or anything else coming up that we can share with the audience?
Yes, all of you who attended, we want you to make sure you go to hamby.org, because that's going to tell you the latest things that we have planned this upcoming year. Those of you who attended this webinar, you can see the wealth of knowledge that Mr. David Luna brought to this little webinar here. When you attend his CE class that will be sponsored by Hamby in October, you will know and you will see why he's such a good presenter, and you will walk away enthused and more knowledgeable about our industry, because it is changing. As we just heard, it's changing left and right, and if we don't stay on top of it, we will be left behind, or we'll make a mistake that might cost us. So we're grateful for David for his knowledge and his sharing his information to us and what he thinks is going to happen this coming year. Rebecca, is there any final questions at all?
No, that's it.
All righty, we get to get out early.
Well, David, thank you very much. We appreciate you, and we might have you on between now and October again. But if not, we will definitely see you here in Hawaii in October at our annual convention.
Thank you, everybody. Cross your fingers on some of the upcoming reports. Hopefully they're going to be easier, and the Federal Reserve will stop raising the Fed funds rate, because after they stop raising it, then they get to lower it, and then that's when it gets to be even more fun. So anyway, everybody have a good 2023. Thank you for attending. We will turn it over to Hamby or Dave. I guess, you dismiss us or let us go.
All right. Thank you, everyone, for attending. Have a great day. Stay healthy, and hopefully COVID-free. Okay. And please check our website, hamby.org, so you can see what our next events will be. Thank you. Aloha.